How's it going, guys? My name is Ishan, and in today's video we're going to be talking about a tech stock that could double fast. On this channel we always talk about companies with real fundamentals that have great upside. We don't talk about risky penny stocks or anything. I called Appian at 45 and now it's at 200, Elastic NV at 80 and now it's at 160, and I also called Domo a screaming buy at $30 and now it's at 70. So the stock that we're going to be covering today has real fundamentals and could double fast. I'm going to go through everything you need to know about them, including a full discounted cash flow model, really showing you how undervalued they are. And at the end, I'm going to be doing a quick technical analysis to show you where exactly to buy in. And so if you appreciate these short and value-packed videos, make sure to drop a quick sub and let's clock in. Before I jump into the stock, I know I've been gone for a while, but I've been working on some pretty big and exciting projects that I hope to share with you guys as the year progresses. But I'm back, baby, and we're back on that daily grind. So the stock that we're going to be talking about today is called Dynatrace. So Dynatrace, it's pretty similar to another stock we've covered on this channel, which is Datadog. And they're actually competitors, but there's a lot of things about Dynatrace that I like that makes it a stock that I think that can still double. So Dynatrace is a company that offers a software intelligence platform for enterprise cloud. Essentially, their software allows their customers to get real-time insights into how their applications are running. So you can do infrastructure monitoring, where you can essentially automatically monitor all your cloud infrastructure and find problems before productivity is actually compromised. Then they also offer business analytic tools which allow companies to pinpoint things like when in the user journey can they improve business outcomes, and also allows them to understand and fix problems before they actually happen. So overall, you can see why they're so important. Now that every company is moving to the cloud, they need tools to monitor it and their applications. And then they also need tools to know how and where they can improve, and Dynatrace fills that gap. And so as we enter 2021, customers want a real-time multi-cloud data gathering analytics suite that offers predictability and allows companies to take actions in a timely manner. And so that's what Dynatrace has to offer. Now jumping into the numbers, here's where things get even more interesting. Sure, they don't have the same growth rate as Datadog, but Dynatrace is still consistently growing around 30% per quarter, and they're expected to grow around 23% next year, which is not bad. So the growth rate isn't anything crazy like Datadog, and I'll come clean here. I would pick Datadog over Dynatrace any day of the year. I've even said that Datadog could still double from these levels. The only reason I'm recommending Dynatrace stock and that I'm personally looking to buy is because I believe that in the short term that they're undervalued, and for the rest of the year that the stock could actually provide some solid gains. Unlike Datadog, they're actually profitable. They've had a 120% net expansion rate, showing that customers are actually spending 20% more than they did the year ago, and they're trading just at a 14 times forward sales, which isn't common nowadays amongst many high-flying tech companies. So taking a look at the discounted cash flow model for Dynatrace, we're essentially going to be figuring out how much is Dynatrace worth today based on how much free cash flow they're going to be generating down the line in the future. So the tax rate that we're going to be using is 21%. Obviously, this might change depending on if Joe Biden raises taxes, which he probably will, but for now, we'll just stick to this 21% tax rate. As for the discount rate, we're going to be using 7.22%. The discount rate, or cost of equity, is basically used to find the present value of the future cash flows. As for the perpetual growth rate, we're going to be using 2%, which is essentially the average of the US long-term bond yields. Currently, the price of Dynatrace is about 43.5 as of me recording this, and they have 282 million shares outstanding. So going down to their free cash flow, essentially what free cash flow is the cash the company has left over after they subtract their capital expenditures. And so it's essentially free money and they can do anything they want with it. So the numbers I've taken are all from various analysts we can see here, and I've created a discounted cash flow model for the next 10 years. So in 2021, they're expected to generate about $188 million in free cash flow, and going all the way to 2030 where they'll generate generate about $1 billion in free cash flow. And so then adding all these free cash flows up from 2021 to 2030 and then using the discount rate of 7.22%, we then find the present value of all this free cash flow, which will be about $4.1 billion. So this is essentially the present value of all this future free cash flow that they'll be generating in the next 10 years. And then from that, we can figure out the terminal value of the company, which will be about $21 billion. Essentially, the terminal value will be the value of Dynatrace for perpetuity after the 10 years. So then using the discounted rate of 7.22%, present value of that terminal value is then $10.6 billion. And so now we can find the intrinsic and total equity value of Dynatrace. And we do that by adding the terminal value and the present value of all future cash flows. And then through that, we get a number of about $14.8 billion. So currently the company's market cap is about $12.2 billion, meaning that if we take the total equity value and divide it by the number of shares that Dynatrace has, which in this case is about 282 million, that means the current value of the stock should actually be around $52.4, meaning right now at 43.5, this stock is actually trading at a 17% discount. Dynatrace in reality right now is actually undervalued, and it's very rare that you see tech companies first of all having consistent growth rates of about 30%, also being in a disruptive industry and being profitable too, to be trading at such a discount. And so that's why I believe that Dynatrace could easily net some solid returns. So this is a company trading at almost a 20% discount just to be fairly valued. And so considering everything we've talked about, Dynatrace has some great potential. This isn't one I'd put too much money in, but it's a safe blue chip investment that will easily net you a minimum of 20% return if things play out right. Before I jump into the technical analysis, be sure to check out the Gen Z Trader Academy. It has over 5 hours of no fluff trading videos that goes over everything from fundamentals to technicals and how I found so many undervalued and cheap stocks like Elastic NV, Appian, Domo, MongoDB, and so many more. And plus I go over exactly how to find technical analysis with stocks like Huya, which we called a couple weeks ago. I called the exact breakout and now the stock is up about 20% from where I called it. So be sure to check out the Gen Z Trader Academy if you want to support the channel and learn something new. So as for a quick technical analysis, we can see that Dynatrace has had resistance around this 44.5 area for quite some time now. We can see every time it pushed back up, it got resistance here and it's failing to hold it. We can see it pushes up, but when it comes back down, it just breaks right through. It's unable to hold this level. And so we also have some support then around this $38 level. We've bounced here multiple times around this $38 level, but as we can see, what's happening now is we're starting to form higher highs and higher lows. We can see a higher low, a higher low, higher high, and we're kind of forming an ascending triangle. If you look at this, we got a horizontal line right over here and a diagonal line right over here. So it seems like we're forming an ascending triangle, and that's usually a sign of a breakout. However, if we also take a look, we've had the same thing in the past. We can see right over here in the past, the stock was also forming higher highs and higher lows and forming an ascending triangle with this horizontal resistance line. And guess what happened? It broke right through and fell back down. So this is what I recommend. What I recommend is waiting for the breakout. What you want to see is for the stock to break above. So you want to see it break above, but then what you want to see when it pulls back down is to hold this resistance line. We want to see it turn that previous resistance into support, because every time it's broken above, it's just broken right through. It's never been able to hold it and turn that previous resistance into support. Same thing over here as well. What happened? We broke above, but we broke right through and we were unable to hold this level as support. So what I will personally be doing right now is to be waiting. I'm going to wait for it to break above and then wait for it to pull back down and give me the confirmation that it's turned this previous resistance into support, and then only I would be looking to buy. because then for all we know the stock just plummets back down to 38, which could be a good level to buy. But ideally what I'd be looking to do is either buying at 38 or buying on the breakout above this 44.5 resistance level. So guys, that's the video. Make sure you like, subscribe, and check out the Gen Z Trader Academy if you want to support the channel and learn something new. And let me know down below what you think about Dynatrace stock, if you plan to buy or not. But be sure to like, subscribe, do all that good stuff, and I'll see you guys next time. Take it easy, clocking out for now. Peace.